Before we dive into tax brackets, quick question. Did you know the UK tax system used to be so wild that today's version actually looks reasonable? I know, hard to believe. So let's start with a history lesson that'll make your payslip feel surprisingly normal. In the 1970s, the UK's top income tax rate was 83%. And if your income came from investments, dividends, rent, savings, you could be taxed at a staggering 98%. 98%. At that point, your money didn't just shrink, it practically disappeared into thin air. And it wasn't just accountants complaining, even the Beatles got involved. George Harrison wrote a whole song called Taxman with the lyric, "There's one for you, 19 for me." Which was an exaggeration. High earners were literally losing 95% of their income. And if you think today's rules are weird, remember this. In the 1700s, Britain literally taxed people based on how many windows their house had. More windows equals more tax. That's why some old houses still have bricked up windows. People were basically doing 18th century tax planning. Forget ISAs or pensions. Just get Dave the Builder to brick up the living room. And here's the origin story. Income tax was introduced in 1799, not for hospitals, schools, or the NHS, but to pay for Britain's war against Napoleon. So yes, our entire tax bracket system exists, because one very determined Frenchman refused to stop conquering Europe. So compared to taxing windows, funding war chests, and taking 98% of investment income, today's tax brackets actually look, well, not good, but definitely less medieval, which brings us to the real question. What exactly are tax brackets, and why do they make your pay rise feel so small? A tax bracket is just a slice of your income taxed at a certain rate. The UK has three main ones: 20% basic rate, 40% higher rate, 45% additional rate. A common myth is that earning £1 over a threshold suddenly taxes all your income at the higher rate. Well, no. HMRC is many things, but it's not quite that evil. Imagine tax as a ladder. Each step is a different rate, but you only pay the higher rate on the step you're standing on, not the whole ladder below. So if you earn £55,000, first £12,570 is tax-free, up to £50,270 is taxed at 20%. The £4,730 above that is taxed at 40%. Only that top slice pays 40%. It's like doing a food shop. Most of what you buy is normal price. Then you add one fancy item, like artisan olive oil that costs more than rent. That doesn't make your whole basket premium, just that one expensive item. Here's where things get spicy. Your personal allowance, the £12,570 you earn tax-free, starts disappearing once you earn above £100,000. For every £2 you earn over £100,000, you lose £1 of your allowance. By £125,140, gone. Poof, like your savings in December. This creates a hidden tax band with an effective rate of around 60%. Once you add lost allowance plus 40% tax, let's see how this works in real life. Say someone earns £110,000. That's £10,000 over the £100,000 threshold. For every £2 over that limit, you lose £1 of your tax-free personal allowance. So for this person, they lose £5,000 of their £12,570 allowance. That £5,000 now becomes taxable at 40%. That's an extra £2,000 in tax, without earning a penny more in take-home pay. And the tax rate between £100,000 and £110,000? That's 60%, not 40%. The UK making maths emotional since 1799. Now, before we move on, there's something important worth mentioning here. Pensions. Because this whole higher band problem, pensions can actually reduce it dramatically. When you contribute to a pension, that money comes out before income tax is calculated, meaning you shrink the portion of your income that gets taxed. So if you earn £55,000 and put £5,000 into your pension, HMRC doesn't tax you as someone earning £55,000. It taxes you as someone earning £50,000, which means less income taxed at 40%, more income falling back into the 20% band. And if you're around £100,000, you can even keep your full personal allowance and avoid that brutal 60% effective rate. So pensions aren't just saving for retirement. They're also one of the only legal ways to stop the tax system headbutting your payslip. For example, someone earns £105,000. They put £5,000 into their pension. HMRC now treats them as earning £100,000. That single move, 1. Saves them 40% tax on that £5,000. 2. Saves them 60% tax in the £100,000 to £105,000 zone. 3. Restores their full personal allowance. That's over £3,000 saved from one pension contribution. That's financial judo. And just when you thought that was enough maths, there's also national insurance. National insurance is basically the part of your payslip that funds things like the state pension, the NHS, maternity pay, sick pay, unemployment benefits, you know, the things your knees will need in 30 years. Most workers now pay around 8% national insurance, on top of income tax on a portion of their earnings, so your 20% tax band often feels closer to 28%, and your 40% band can feel closer to 48%. Quick sidebar. You might also see weird numbers on your payslip like 1257L, BR, or K500. Those are your tax codes, little messages from HMRC telling your employer how much tax to take. For example, 1257L is the standard code for most people. BR is all your income is taxed at basic rate. K codes is what you owe tax on income that isn't from your salary, like benefits or unpaid tax. Think of tax codes as quiet little signals, usually accurate, sometimes mildly incorrect, occasionally chaotic. So that's the UK tax bracket system. Confusing? Yes. Unfair? Sometimes. Designed by someone who hates simplicity? Absolutely. But once you understand the slices, you can plan better and stop wondering why your payslip looks tired every month. If you enjoyed this, hit subscribe, like the video, and share it with a friend who still argues with their payslip, as if it's going to argue back. And I'll see you in the next one, where we'll make another confusing topic feel slightly less tragic.